This is Frank Willery from Willery Win. I'm going to do a presentation today on CECL and ALM validations, but want to give everybody just one more minute to sign in. Okay, I'll get started. Welcome and good morning. It is an honor to be presenting to Baker Tilly today on CECL and ALM validations. Both of these are thriving business lines for Willery Win, and would like to say congratulations to Baker Tilly and to Moss Adams on their recent merger, which was closed and now to become the sixth largest accounting and advisory firm in the United States. So again, congratulations on that. Uh, with respect to housekeeping, there's one statement that I need to go over related to CPE. I want to go over some important information regarding how you can earn 1.5 hours of continuing professional education credit for this program. To earn full credit, you will need to attend at least 75 minutes of today's session. Additionally, we will be posting 6 polling questions throughout the webinar. You must answer at least 5 of these 6 polling questions to earn full credit. Please note that you do not need to answer these polling questions correctly. Just sufficiently answering them is sufficient. At the end of the webinar, a survey will launch. While you aren't required to complete the survey to earn CPE credit, we at Willery Win would truly value any feedback that you have. The CECL validation section in particular is new presentation material for Willery Win. So if you do have any improvement ideas, just please let us know. And then related to the CPE certificates, they will be sent. To the email addresses that you registered early next week. So thank you very much for that. And today's session is on CECL and ALM validations. And having trouble moving the slide. One second. So there we go. All right, here we go. Thank you, Annalise. Annalise is here to help me with any technical difficulties. So let's see. With respect to validations, if you know the Willery Win philosophy is if you're going to be engaged for a project, do it well. So with respect to validations, we think that we kick the tires hard, and then we'll tell the clients what we find, good or bad, with the goal being to further improve the processes. So we tried to provide recommendations on how to proceed forward with a better process. Some processes are tight and you don't find many improvements, but often we do. And again, we're trying to make the industry better. So looking at what we're going to cover today, we're going to cover validation governance. Again, what sort of drives validation philosophy. Then with respect to validations, we're going to go over the model selection and the requirements of the models. We'll go over testing techniques, and then we'll have sample recommendations. So again, these were actual engagements, but we'll disguise the names and just kind of give a flavor for what we're seeing. There's 2 parts to this. So number 1 will be the CECL model validation, where we'll cover the CECL policy, the model types, the model testing, and then sample recommendations. And then part 2 will be ALM validation, where we'll cover the ALM and related policies. We'll also cover net interest income, which is the way in which short-term interest rate risk is measured. Net economic value, which is the way that the long-term interest rate risk is measured, and go through some sample recommendations there as well. This is Some information on my background specifically. Most of you are familiar with Willery Winn. In case that you're not, Willery Winn has 25 employees, and we have clients in all 50 states. Our clients are a mix of credit unions and community banks. We offer 4 business lines: mortgage servicing rights valuation, fair value, usually related to merger activity. We have asset liability management business line, and of course CECL. And as a firm, I'm really proud to say that we've just started our 23rd year, and we are thriving today because of referrals that we receive from audit firms like Baker Tilly, and I'll say Moss Adams too, because the merger is recent. And I just wanted to say thank you for the support. It really does mean a lot. Again, 23 years, this is our 23rd year of doing business. When we reached 20 years, I looked up some SBA statistics and what was the probability of making it 20 years, and it's really 20%, right? So just 1 in 5 make it that year. But because we have a great team, we have great clients and great referral sources as well. I think that's the reason for our success and why we're around today. With respect to my background, I've had over 30 years of experience, and I kind of have this slide and speak a lot, so I remember when it was over 10 years, then over 20 years, now over 30 years, and I've been helping financial institutions for the past 22 years. So been an absolute pleasure, and it has gone fast. Let's see.
Just click on that screen.
Okay. Oh, here we go. So related to Willery Winn, and then I'm going to loop it back to validations, but Willery Winn's mission, and this would be on our website, but our mission statement is to strengthen community financial institutions. And one of the ways that we strengthen financial institution is through validations, both the CECL and the ALM. We do validate all of the industry's primary models. For CECL validation, our goal is to perform an efficient replication of the CECL calculation while providing our clients with actionable modeling improvements and process insights. For ALM validation, we first obtain data and assumption set inputs and perform an independent replication. So from those data and assumptions, we go to a separate model and try to create the same results. We analyze the data aggregations, the inputs and results, and compare to industry standards. And then as a final step, we make recommendations regarding the client's interest rate risk profile and the organization's risk tolerance. Related to our CECL validation, because of our ongoing quarterly CECL business, we can provide clients with our discounted cash flow CECL results for comparative purposes. So for instance, if a client is using a warm model, for instance, we can run, if it's presupposing they have the data, we can run our discounted cash flows and compare the results and compare by product levels. For the ALM validation, our independent replication for ALM is done with the ZM-Desk Moody's model, which we consider the best in the industry. Related to model validation, this covers all models. There's supervisory guidance on model risk management, so SR 11-7 or OCC 2011-12. Issued by the Federal Reserve and the OCC respectively. It emphasizes the importance of model validation for mitigating model risk and ensuring models are performing as intended. Key focuses include model development, implementation, and ongoing monitoring. The interagency guidance clearly states industry best practices for ensuring models are working as intended, and of course CECL models and ALM models certainly fall under this guidance. There's the gold standard approach to model validation, which we believe we employ here at Willery Winn, is a thorough review of the model documentation, kind of starting there, a full evaluation of the model assumptions, a data quality assessment, an independent replication to make sure that the calculations are working as intended, sensitivity and stress testing, and then also benchmarking and back testing. Just in case you haven't had the opportunity to read SR 11-7 or OCC 2011-12, I decided that I'd provide some excerpts that I think provide insight for doing model validation the right way. And so the first would be the use of models invariably presents model risk, which is the potential for adverse consequences, including financial loss, from decisions based on the incorrect or misused model outputs and reports. Second excerpt, model validation is a set of processes and activities intended to verify that models are performing as expected in line with their design objectives and business uses. All model components, including inputs, processing, and reporting, should be subject to validation. And the last excerpt that I brought from the guidance is validation should be done by people who are not responsible for development or use and do not have a stake in whether the model is determined to be valid. So again, that last point leads to engagement by independent outside experts to really test the processes and provide feedback. Again, related to SR 11-7 and OCC 2011-12, which essentially say the same thing. It's just kind of different regulator that put it out. An effective validation framework should include 3 core elements. The first being an evaluation of conceptual soundness, including developmental evidence, so assessing the quality of the model design and construction. Second, the ongoing monitoring, including process verification and benchmarking. Such monitoring confirms that the model is appropriately implemented and is performing as intended. And then outcomes analysis, including backtesting, a comparison of model outcomes to actual outcomes to ensure that the model is working as intended. And again, these 3 core elements listed above are also listed in the AICPA CECL practice guide. And so again, I thought it was well written, and I guess the people at the AICPA also did, as they included it in their practice guide. Speaking of that AICPA CECL practice guide, I did look at that and also sort of searched it for what it had to say about validation. So as you know, the CECL practice guide, it offers audit considerations for CECL, focusing on internal controls, data reliability, model assumptions, and audit committee oversight. But 2 excerpts that related to validation that I found in the practice guide: has management created robust processes to develop the expected credit loss model and model validation controls to verify the model is performing as expected? And the second one is the auditor's understanding of the model includes understanding management's validation process. So again, when Willery Winn creates model validation reports, so this would be for CECL or for ALM, we do realize that there are multiple audiences for that report: the financial institution client, the auditors, the regulators, and we try to make sure that all perspectives are covered. So we do read the guidance, whether it's from the regulators or from the CPA as well, just to make sure that we understand it, because we really do sort of live where finance meets accounting, and for regulated institutions, it's important to bring all those perspectives together. And as we kind of continue through, guidance and governance, we also have to bring up SEC SAB 119 as it relates to CECL. So Staff Accounting Bulletin 119 provides updated guidance on measuring current expected credit losses under ASC 326, focusing on systematic methodologies and the necessary documentation for allowance estimates. It emphasizes the governance and internal control considerations. One excerpt that I put in here, the staff believes that management should support its validation process with specific validation procedures performed, including findings of an independent reviewer. So again, with all the governance, it does talk about validation in detail. And now that we've covered the governance part of this, now we're going to go into the CECL model validation, and we'll launch polling question number 1, and then we'll start covering the CECL. So to estimate credit losses, most of my clients use 1, the WARM method, 2, the vintage method, 3, probability of default method, or 4, discounted cash flow. A little bit more time for responses. Yep, let's end the poll. Do I need to do that? Okay.
You're good.
Okay. So it seemed like the first one was discounted cash flow. So was good to see that, because I do think that provides the most accurate measure of a CECL estimate in ACL. Second, I did see that it was the WARM method, right? So the WARM method would be the simplistic method, and we'll kind of go through those methods in a little bit more detail as well. So again, we'll just start with some basic background on CECL. The current expected credit loss requires companies to recognize lifetime expected credit losses, not only based on past events and current conditions, but also on reasonable and supportable expectations regarding loan balances and loan losses over time. Why was CECL estimated? It was definitely in response to the 2008 financial crisis, where the reserves were sort of slow to catch up to reality. Forward-looking estimates, and the goal is of course timely recognition of expected losses. Related to the timely recognition of losses, we do have a white paper available on our website where we back tested a discounted cash flow model against a WARM model prior to, during, and after the financial crisis to see what would occur. And with respect to timely recognition, the discounted cash flow model substantially outperformed the more simplistic WARM model. Not surprising at the results, but it was a good back test that we were able to do, and thought it would help the industry if we published that. So now we'll go over the CECL model types. The next few slides are a review from our previous CECL presentation, but we do need to cover them again as they are relevant for CECL validation as well. After the model explanations, then we're going to go back to validation specific slides. So again, we'll take a look at the WARM model first. So it estimates credit losses based on the weighted average remaining maturity, applies historical loss rates to projected future cash flows over the remaining life. And, as an example, for credit cards, we have 135 million, an annual loss rate of 86 basis points, and weighted average maturity. So you multiply A times B times C to get to D, which would provide the CECL percent. So the 86 basis points times the 2.75 remaining maturity times the 135 million. So again, you aggregate that up to get the CECL amount. What's the advantage of a warm model? It's simple and easy to use, very low data requirements. What's the disadvantage? It's backward looking. There's definitely accuracy issues, especially as you look back over the COVID-related pandemic stimulus and collection practices, where there really wasn't much for loss activity, and also a lack of predictiveness. So we then move to the vintage model. So the vintage model tracks credit losses based on the origination date or vintage of the loan. Credit losses are estimated based on the historical performance of each vintage cohort. So again, vintage could be 2019, 20, 21, 22, etc. And it provides insights on how different economic cycles or underwriting standards impact losses over time. So again, we can see in this particular example, so we have our vintages, and so we have our different origination years. So the 2019 obviously has more history going through. So what's known sort of becomes the guidance for what is unknown. So again, we can see the 3 basis points here for 2019 getting out to year 5. So that assumption is used in the out years for the other vintages. The year 4, it's sort of a mix of 12 basis points and 18 basis points. So you see 15 being utilized kind of in the out years here. So again, you end up having the reserve based off the vintage analysis. Of course, there can be some qualitative adjustments to it as well that would kind of be added on top of it. As you kind of go through the vintages, you're sort of looking at what remains. So again, in this case, it's 3 basis points. In the next case, it's 3 basis points plus 15 basis points for the 18, etc. As you're just getting more and more vintages. You can add some qualitative adjustments on top of it. It's a vintage model. What's the advantage of it? It's easy to understand and implement. It does show historical trend analysis as well. Disadvantages is just forecasting limitations using historical losses and assuming that's going to exactly project forward. The market conditions could be different. The origination quality could be different, underwriting different. etc. And you do have some outlier sensitivity as well. The next model is the probability of default or loss given default model. And there's 2 components here. One is the probability default, and the second is the loss given default or the loss severity. Again, looking at historical data, and it looks at recovery rates in the past. And so, for instance, if we look here, we have a $100 million loan balance. The non-performing assets is $3 million, giving a probability of default of 3%. The net charge-off was $440,000 of the $3 million that charged off, so it gives a loss given default of 14.67%. And so this is done, and in this case, it looked like it's a 10-year period, and so you do see some difference in the probability default and the loss given default. Overall, it will factor in on the medians as we bring them down, and can add additional reserve as well. What are the advantages? It's intuitive and transparent. There's definitely reduced subjectivity to it. Disadvantage, definitely increased data requirements, and again, the data of the past might not be representative of future conditions. And now we have the CECL model that we're covering is the discounted cash flow. And this time we've just provided an example of what discounted cash flow looks like. So again, we have conditional repayment rate. So this is the voluntary payoffs of 15%. We have the conditional default rates, which is the involuntary at 1%. So 1% of the year 1 balance will default by the end of year 1. A loss severity of 20%. And again, we look at the net present values of the cash flows, look at the amortized cost, and the difference is the CECL reserve. Discounted cash flow is What's the advantage? It's a prospective view. It can accommodate cohorts. For instance, you can do discounted cash flows. You could look at a cohort of used auto loans that are indirect, 600 to 620 FICO score with a term of 84, original term of 84 months. So again, it's real conducive to cohorting and providing really detailed accurate loss estimates. What are the disadvantages? It's complexity, harder to review, and there's computational demands to it. It's definitely time tested because again, this is basically the Wall Street math. It's covered under SIFMA. So all the Wall Street firms got together, 40 years ago and decided, hey, if we're going to do math related to mortgage math, we're going to have conventions. It's going to be the conditional repayment rate, conditional default rate, loss severity, and it's all going to fall under the SIFMA standard. In the SIFMA standard, you could replicate that standard to make sure that your models are accurate. So again, it's definitely been time tested. And it is definitely a more accurate way to measure future losses, assuming you have the cohorts to do that. Okay, now that we covered the various CECL models and we've covered the governance, now we're going to get into Willery Wynn's CECL validation process. Now, we realize that Baker Tilly offers CECL validation services to clients as well, but we are going to definitely detail our approach, and the reason that we're going to do that is for the benefit of the industry. So again, incorporation of best ideas. What's Willery Wynn's approach to CECL validation? If you've seen like a Willery Wynn report, it's always sort of a tell a story with numbers approach. So kind of understand the client, understand their business model, do some comparisons, and then do your testing and kind of tell a story with numbers. We still do that with our CECL validation, but in addition to that, we also have a checklist just to make sure that we're checking the things that we need to check as we go forward and we're doing the as we're reviewing the different areas. So the areas that, and we'll go through what we check for and how we check for it, what the recommendations are, and I am sure Baker Tilly does some things, does that in a similar way, although your phrasing or what you call it might be different. But our validations, we start with the CECL policy. We do then we look at the model selection. What CECL model did you select and why? We do the very detailed testing. This one's more Willery Wynn. We always do benchmarking of financials to peers. We're just trying to understand the client's business models as we make recommendations for improvement. And again, we're going to go through kind of a list of the subcomponents that we test for CECL. So we'll start with CECL policy. We'll read the CECL policy, and the first thing we'll take a look at is the governance. What's the board of directors role, and then what is delegated to management, and who's responsible for what. So we'll look at that. Documentation, internal control, data validation. So, for data validation, what is the process implemented to make sure the data is both complete and also that it's accurate? And then we'll look at the model change update process, policy updates. How often is the policy updated? How is it updated? Listing of the key model assumptions. Is that in the policy or not in the policy? And what's the monitoring plan? And the monitoring plan would involve back testing, comparison to alternative models. As we're going through and we do the checklist, we're looking for gaps between the policy and what the business is, and then we're going to document our findings and have preliminary recommendations for better alignment. I would say since the implementation of CECL policies is a fairly recent event, we see considerable variability in the quality of the client's policies and often have recommendations on how they can be substantially improved to meet best practices. As we're going through this, like sometimes we'll see a policy might be a little thin and not cover what it needs to, but you'll start talking to the business and find out that they're actually doing a lot of testing and back testing, and there's a lot of controls in place, but they just didn't put them into the policy. So we'll make those sorts of improvements. I think as time goes on, we'll see better and better policies, but as of right now and what we're seeing for validations, we see a mix, and it's not uncommon that we have lots and lots of policy recommendations. And it's probably likely that Baker Tilly's seeing that as well. Analysts, let's do polling question number 2. So most of the CECL policies we audit define the role of the credit committee and back testing, the credit committee just back testing, or none of the above. Seems like as the poll's going through, it's good news is it's the credit committee and back testing. So I'm glad that both are in the policies, but not surprising. I see some none of the above and some that are the credit committee as well. So again, not surprised. The policies, I think they'll be shaping up over the next year or two. All right, let's close the poll. So now we're going, we've looked at the policy, we're doing our validation. So now we're going to look at the CECL model and the results of that model. So we start by just having a summary of the results, and then what model was selected and how was it implemented. Is it vintage, advanced vintage, etc. What other was looked at, and why was the decision made to choose what was chosen. Segmenting process. And so segmenting is one where you can really see how much precision will be as you go forward. For instance, segmenting could be for auto loans, it could be, we could have new separated from used, direct separated from indirect. We could have FICO buckets, and then it could also be broken out by term, right? Because that will have the most detailed way to predict losses, right? Because with low FICO, long-term, indirect, used loan, that would definitely have the highest losses, right? Or segmenting just auto loans as one category? Because we certainly see that a lot too. For mortgages, are they broken out just between first and seconds, or are they broken further out between LTV and CLTV and FICO score ranges, right? So segmenting process we take a detailed look at. Individually evaluated loans, and so once loans are impaired, they're usually looked at separately. So for instance, given that a loan is 60 days or 90 days delinquent, they're individually evaluated, looked at on a loan by loan basis. So a more accurate reserve, CECL reserve, occurs on those loans. Again, pretty common to see individually evaluated loans or pools of those, because again, if you're originating, you're going to have some that are issues. What is the look back period, right? How far are we looking back as we're looking at losses? And look back period is another one that's critical, right? Are we just looking back over a couple of years where it's just COVID related stimulus, which is going to have some, pretty, historically it was good performing years? Or are we going to go back to the financial crisis and kind of incorporate that? Because when there was a housing crisis, it was a much different world. So how far is that look back period for that that's being utilized in the CECL estimates? Is credit scoring used? Is risk ranking used on commercial exposures or member business loans for credit unions. Delinquent loans, are they looked at individually, or are they looked at in some other way? And then again, what economic variables are selected? You usually see unemployment, and hopefully it's regional unemployment forecasts. And then it could be housing price appreciation on the mortgage side as well. And then what's the reversion, and then what regression analysis was used. And again, we then, after we go through the checklist, we look for potential gaps between the CECL model and the business needs, and document findings and preliminary recommendations for improvements. Okay, so the next part is now that we've covered the policies, we've covered the CECL model, why it was selected. Now we have the CECL model testing that we do. And so we start with historical loss analysis. So what was the annual net charge-off ratio in comparison to the ACL reserve? And hopefully the reserve wasn't extinguished in less than a year, right? So that makes sure that we have a good process there. We'll do an independent replication. Does the math work on the model? And then we'll look at prepayment, default, loss severity, delinquent loans again, discount rates to the extent that it's a discounted cash flow approach, just making sure that that's correct. Quantitative and qualitative testing. We're seeing big differences when we're doing the CECL validations between quantitative and qualitative, right? So, and then we sort of have, as an aside, we have our business that we do CECL for too. So for Willery Win clients, because we use the discounted cash flow and we break into very detailed cohorts, for the most part, we're very quantitative, right? There's sometimes some qualitative, could be a new loan product that we don't have the history for, less familiarity with, but there's always some qualitative aspect. For the most part, we're heavy quantitative. We'll also see other organizations that implemented some, vintage model, but they don't have much of any historical losses, which is, I guess, a nice problem to have. But a lot of their reserve going forward is qualitative, and then how do they support that? So then, we'll look at back testing and benchmarking. So in the benchmarking, we're trying to compare to financial institutions with similar business models. So if organization is heavy into auto lending, we'll look at other organizations that are also into auto lending, or kind of making those sorts of adjustments. Is the organization doing stress testing? For instance, we'll do moderate and severe stress on the CECL work that we do, and it's kind of based off a regression analysis. What are they doing on the unfunded loan commitments, securities? What do they have? Is there any ACL needed for the securities that they hold? Are they in compliance with GAAP, and are they in compliance with other provisions? The last part, and this is one that we do, I think this differentiates our CECL validation business. We can also, if a client supplies us with the data, we can run it under our model and say this is what we would advise that the CECL reserve would be under a discounted cash flow approach. So it could be compared to vintage or advanced vintage or warm, or whatever the client is using, or we could look at specific products in general, if that is of interest to the client. And then a last part, this is also kind of unique to Willery Win, but on our CECL validation process, we do look at the business model. So we look at the balance sheet, the loan portfolio composition, asset quality, and then capital. And again, using these peer groups comparisons, I definitely always want to understand the business model that the clients are utilizing, just to make sure that our advice makes sense. And we've been doing that approach for a long time. So we just brought that into our CECL validation business as well. Here's some examples, right, in terms of just replication. can we check the look back period? So this was a client that was using advanced vintage analysis, and we looked at the base loss rates that were being utilized by their software vendor that they subscribed to, and then we were trying to independently recreate it. There was a little gap, definitely a gap here, 13 basis points for 11. So that's whenever there's a gap in terms of your validation, then you're asking more questions and you're drilling down in additional detail to decide what's driving that. And then secondly, then you're using logic to decide what you do about it. And then we're doing industry benchmarking as well with respect to our CECL validation process. So this is another example where we have ABC Credit Union and kind of compared to a group of peers. ABC has a higher ACL than its peers. They've had a higher charge-off ratio than their peers, but they also have way higher delinquencies than their peers. Based on a comparison to charge-off ratios, they look pretty similar here, but compared to the delinquencies, it almost looks like the ABC Credit Union should be higher in terms of the reserve, just based on kind of the high delinquency levels that they have. So that type of peer comparison, just we're doing that, kind of seeing what it would take, and then having discussions on that. So this is one where, although they're higher, it looked like they're based on the delinquency levels might be a little bit higher still. So again, in this example, we're looking at the quantitative forecast adjustment, which is adding to the ACL. So we're looking, you have sort of the base loss rates, and so we have a situation where the future economy is predicted to be worse than the past economy. So there's a quantitative forecast adjustment. This was offered by a software vendor. And so this particular software vendor had these adjustments, and they could do it on either national, state, or MSA forecasts for unemployment. And then there's back testing on the correlations. So in this case, the state happened to be higher. And so you could use that prospectively. But if the forecast rate is higher, forecasted unemployment is higher in the future than it was in the past, then there is these sort of quantitative adjustments that are calculated through regression analysis. So certainly we, like the others that validate, need to kind of get into the details, into the weeds, and validate that. And then, we'll also do analyses, qualitative versus quantitative. And so in this particular case, we had a client that was 68.53% quantitative. We're looking at the qualitative. Did it make sense at the 10,000 foot level? Turns out that they were having some performance issues related to some originating some, it related to a lot of indirect dealer relationships, and they were in the process of cutting off some dealers, but there were some of those loans in the pipeline that were adding some of these qualitative adjustments. So again, there was really good support for those adjustments. And then back testing, just a back testing example. So again, this is some actual losses, which are this maroonish color, are the actual losses for various periods: 331, 630, 930. So we're looking at the actual losses and then comparing it to what did the discounted cash flow model project, right, for the losses. And the discounted cash flow model looked like it was slightly over predicting losses, just slightly, not a lot. We also compared it to the WARM, and WARM was under predicting the losses. So again, back testing is part of it to determine whether adjustments need to be made or not. And as I mentioned before, this is we can do an independent CECL evaluation. So again, we can look at the product mix, and we'll take a more detailed look because we'll break into like our very detailed cohorts to the extent that information's provide, and um, then kind of compare it, because if we're doing an independent CECL valuation, we can see what products we're kind of seeing the same versus difference, what those differences are. So again, in this particular case, I think we saw some differences in used autos, and we thought the reserves, our modeling indicated that those reserves should be higher, and advise the client to kind of take a look at it. So again, here's some sample commentary related to both CECL policies and CECL testing. So this was a policy where our recommendation was Willery Wynn recommends that the policy be amended to reflect the roles of the credit committee, supervisory committee, and management as they relate to data validation, backtesting, internal controls, and monitoring for the CECL process. This was an example where the client was doing these sorts of things, but they weren't actually in the policy itself. Some commentary, we're looking at the reserve and how much is quantitative, and also kind of looking at other things as we're we thought that there's an organization here in this example that had pretty limited loss experience, so we're making comments on how they can better incorporate industry data here for CECL. And again, I think we'll see some things that were similar here, where this was in this particular example, sufficient balance history wasn't available, so they were trying to figure out past balances through reverse decay analysis. And so reverse decay analysis is not exact relative to market conditions. So we're noting that here. I think this was another one where advanced vintage analysis was being used, and it seemed to produce some kind of different results for the smaller pools that we're looking at, or making the client aware of that as well. But lots of sample commentary. Here's another one that related to policies, different client, but kind of similar theme. We recommend that ABCCU amend its CECL policy to reflect the roles and responsibilities related to data validation, backtesting, and model validation, frequency and scope. Not uncommon that we're making policy recommendations. Here's another one. Since the minimum reserve levels, economic adjustments, and other adjustments aggregate to 82% of the total ACL, we recommend that the CECL policy include how these amounts are determined, tested, and adjusted. When we were looking at this one, the reserve level kind of ended up being somewhat reasonable, but it was a little bit arbitrary. So just helping that client find support for coming up with those sorts of adjustments. Another one that didn't have a lot of loss history to push off from, which is I guess a nice problem to have. We recommend that ABC Credit Union expand the look back for losses on the residential real estate static pools beyond 4 years to include a full peak to trough business cycle. Another common recommendation, looking back 4 years, that's COVID related stimulus years, and a full cycle that would include the financial crisis would be much better to push off from. And sometimes it's better to be lucky than good, but because we had a footnote valuation business, we've been analyzing detailed cohorts back before the financial crisis. So when most organizations go back, they're going back in time based off call report data at that level, where we're going back at the detailed cohort level, because we do have that data at the loan level. So it's been a nice advantage for us as we try to forecast lifetime losses prospectively. Another one related to regressions. The software vendor for ABCCU fits linear regressions between annual charge-off ratios and economic data, unemployment and housing price indices for different loan types at the MSA, state, and national level. While National was selected, our research has shown that the performance for auto loans is highly correlated with changes in the local market's unemployment, and we recommend changing to the MSA level. It's just going to give you a better look as you go forward. But it kind of just shows us, as you know, when we're doing this, that we really do get into the weeds and get into the details of this as we're doing the validations. Because again, if you're going to do something, do it well. This last one talks about our independent replication, and this one, I definitely disguised this one from the actual numbers, but Willery Wynn's discounted cash flow model, which is based on credit attributes of each loan, produced a quantitative reserve of 20,152,100 compared to the total reserve of 18 million plus produced by the XYZ model. We recommend that ABCCU review and consider applying Q factors for used vehicles, first mortgages, and HELOCs. At this point, we'll stop and launch polling question number 4. Most of my clients apply macroeconomic data in their qualitative reserve, quantitative reserve, in both, or none of the above. At this point, both qualitative and quantitative reserve is leading, followed by just the qualitative. Okay, let's close it out. And so that will conclude the CECL validation section of the presentation. Now we'll move to the ALM validation part of it. Now we certainly realize as auditors that you're going to be looking at CECL a lot more than the ALM, but the ALM is still interesting because it's good to know, and as you're out communicating with clients, it'll provide some good understanding as to the challenges faced by financial institutions and making sure that they can effectively manage the institution as they move forward. So for the ALM, so asset liability management, it's the practice, or ALM, it's the practice of managing risks that arise due to mismatches between assets and liabilities and earning an adequate return. ALM considers interest rate risk, liquidity risk, and credit risk, and ideally measured on an integrated basis. Interest rate risk is the risk of potential loss that can be triggered by movements in market interest rates. Liquidity risk is the risk of not having enough cash to meet an organization's financial obligations due to an overextension of assets or volatile funding sources. And credit risk is the risk of loss due to borrower loan defaults, which impact a financial institution's earnings and capital. So all financial institutions have interest rate risk. For long-term success, that interest rate risk needs to be measured, it needs to be monitored, and it needs to be controlled. Producing some examples of why that's important. Interest rate risk, the best example of interest rate risk gone wrong is the S&L crisis, savings and loan crisis, in the late 80s and the early 90s, where the long-term assets were mortgages, and the mortgages were originated under a low interest rate environment, and the short-term liabilities, the rates on the liabilities were higher than what was on the assets as market rates increased greatly during that period. So it kind of gave birth to duration analysis, which we'll talk about later. So again, interest rate risk is definitely key on examiner and financial institution minds. Liquidity risk, we only have to look back to 2023 failures of Silicon Valley Bank, Signature Bank, and First Republic Bank, where they had large concentrations of uninsured depositors that got wind that the organizations had underwater investments for quite a while. And it was just kind of a good old-fashioned bank run there, and the liquidity just couldn't keep up. So liquidity crisis and credit risk. That's the 2008 financial crisis, which was triggered by the collapse of the U.S. housing market, and in that collapse, that credit risk exposure sank numerous institutions on financial institutions, unfortunately. So again, this stuff is important, and it's the lifeblood of the credit unions and community banks. So interest rate risk is measured by assessing the impact of sudden and significant changes to market interest rates in comparison to an expected base case loss, and it's measured against predetermined tolerance levels to interest rate shocks as a financial institution's ALM policy. So there's the base case scenario. This is future rates unfolding like we thought. Then we shock all assets and liabilities. We shock the market up 100, up 200, up 300, down 100, down 200, down 300, instantaneous and parallel shifts, and kind of see what happens. And so the tolerance levels are saying, okay, in a down 300 scenario, my net interest income can vary by, say, 15%, and my economic value of equity can change by 22%. Those are sort of those predetermined tolerance levels that are in the policy. So net interest income simulation, it's short-term. It's a way to measure short-term interest rate risks, and so there's a constant balance sheet assumption over either 1 year or 2 years, and the net interest income shows the impact of assets and liabilities as they reprice in a multitude of interest rate environments. To say, like, and as long as assets and liabilities are repricing similarly or closely, then there's not undue interest rate risk. And again, this is a lot of it is post S&L crisis, where this is a huge emphasis and has been for a long time. Economic value of equity. This is present value calculations for all assets and all liabilities using discount rates. It's a measure of long-term interest rate risk. It's definitely theoretical and sensitive to assumptions. So if we look at Willery Win, as we look at ALM validation, the policies there's more work to be done here than CECL. And CECL, there's just sort of a CECL policy for asset liability management. There's multiple policies that we review as part of our validation. We do asset liability management policy. We do concentration risk. What's concentration risk policy? It's asset type limitations or liability type limitations. Very important, like I said, we can only have so many commercial loans. They can only be so big as a for instance. Example of concentration risk gone wrong, credit unions that have high concentrations of taxi medallion loans prior to Uber being formed, right? And so some of those institutions are no longer here due to taking undue concentration risk. Contingency funding, how to fund the financial institution during a liquidity crisis. Investments, what's permitted, what's not permitted. And so for our ALM, asset liability management testing, we do an independent replication in our CM Desk Moody's system. And so we'll do the net interest income and the economic value of equity and just compare our independence using the same inputs and using the same assumptions. Are we getting the same outputs? Are there differences? And if so, how do we investigate those and what's the cause of it? And then just because we can replicate it doesn't mean that it's good necessarily, because we have to also test the ALM assumptions. We'll test the loans and investments, which will be the repayment rates, default rates, and loss severity, and then the non-maturity deposits, and we'll go into this in more detail on future slides, but we're going to look at the beta, so how much did these administered rates change relative to the market changing. So again, how much would a checking account change if the market changes 100 basis points versus a money market versus a savings account? decay? How do these pay off? It's similar to repayment rate, but how does that change in up and down environments, and effective maturity? There is not on a checking account, savings account, money market account, there's not a stated maturity, but there's mathematical ways that we find effective maturity that from a modeling perspective essentially kind of cuts off the cash flow, similar to like a balloon payment. We'll go through that in more detail. And of course, since we're Willery Win, we always do the benchmarking of financials to peers to understand the business model. So what are the key asset liability management model assumptions that we're going to look at in terms of our validation? Conditional repayment rates, so that's the voluntary payoffs. Either I'm paying it off because I'm moving to a different place, or I'm making curtailments, paying down the mortgage quicker. Conditional default rates, the involuntary. Hopefully the people are using the cohorts to determine what the default rates are. Loss severity, which is the opposite of recovery, but also includes liquidation costs. And then on the non-maturity shares, how long are they going to remain with the institution from a model perspective, and are these assumptions supported by deposit studies? Future pricing, how are the financial instruments repricing as they go forward? And then there's discount rates used for determining present value of economic value of equity calculations. And so one of the things that's important for financial institutions in terms of asset liability management, which we'll look at in terms of our validations, is duration. And what is duration? It's a measure of price sensitivity to interest rates and what's involved in a yield, principal repayment, and present value. Higher duration implies more price volatility risk. And I'll just give an example. So let's just say we have a fixed rate asset with a duration of 4. In the base case scenario, let's just say that asset's worth 100. In the plus 100, because now we're getting a lower yield than what would be required by the market, it's a 4-to-1 trade-off. So in the plus 100 environment, it's worth 96, 100 minus 4 for the duration. And in the minus 100, where you're getting a higher yield than what the current market, it would be worth 104. So again, the duration is a measure of price sensitivity. The higher it is, the more risk that there is. To reduce or mitigate interest rate risk, asset and liability durations need to match, and duration is calculated with economic value of equity analysis. So here's some duration calculations. I put these here as an example. So again, we can see that agency mortgage-backed securities have a duration. It looks like it's just around 4 for some of the securities, whether they're CMOs or they're agency MBSs. Consumer loans have a shorter duration, 1.38. The real estate loans, 3.4. So again, we're looking at this sample institution, and their overall assets has a duration of 2.4. So that's pretty good, pretty short duration. Their non-maturities, their checking accounts, not surprisingly, have pretty long durations, a little north of 4 years. If we look at their CDs or their share certificates, it's less than 1, kind of some short-term CDs there on the liability side. Overall, their liabilities are 2.99 on the duration on the liabilities versus 2.4 on the assets. So assets are a little bit shorter than the liabilities from a duration perspective, but overall pretty good balance here. There's not an institution that has it exactly right. Like there's usually one longer than the other, but you can kind of see how it varies by product and what financial institutions are looking at in terms of managing duration. Because again, you can decide that, okay, well, based off this 2.99, they could do a little bit more on the longer term investments or real estate just to kind of even those up. So they're in pretty good shape here. Looking at interest rate risk, interest rate risk is created by a mismatch in asset liability durations. You'll hear some terms like asset sensitive, liability sensitive, right, as you're out meeting with clients. But if the asset duration is 2 years and the liability is 3 years, um, the organization is asset sensitive since the assets reprice quicker, and they're going to perform better as rates rise because the assets can quickly reprice into the higher rates. On the for liability sensitive, if the assets are 4 and the liabilities are 3, they're liability sensitive. And so on liability sensitive, they perform better as rates fall. So again, because you're getting this increased yield in the lower environment, your liabilities are repricing, and showed a balanced example as well. So can we do polling question number 5? Okay, so the ALM assumptions that have the biggest impact on earnings simulations are repayment rates, conditional default rates, loss severity rates, or non-maturity share persistency. All right, conditional repayment rate, yep, probably true. So you can close the poll.
Okay.
We're going to launch one more polling question because we must have glossed over one as well. So we'll go back and do polling question number 4, right? Okay. The qualitative component of my typical client CECL reserve is less than 10, 10 to 20, 20 to 40, or more than 40. So far we have less than 10 and between 10 and 20. That's good. At least in the example I looked at, I had a few that were more than 40.
Okay.
Okay. Okay. So what this example shows is a comparison with slight variances to our independent replication in the totals. So what we're looking at here is earnings simulation, so 1 year interest income, and we're looking at the client's results, so ABC Credit Union in the minus 300, minus 200, minus 100, etc., in their scenarios versus our independent replication. So again, we're trying to see if their model works, and so we're trying to, given the same data and the same assumption set, are we getting the same answers? And we see some slight variances here, not huge variances, but slight variances. So when we find these variances in the validation, then we just kind of drill down further. So instead of just looking at it at the consumer loans, like in the slide, we'll dig down into the consumer loan types. And make sure that we see, like usually when we see a little bit slight differences in interest income, most of the time those differences relate to a client having some incorrect setup on the adjustable rate side. Could be caps, could be floors, just could be the way that they're doing their arm loans. That usually what it comes down to. And we look at the liability side as well, just to make sure that we can replicate it. And in addition to the net interest income, we also are looking at the economic value of equity analysis. And again, in this particular example, so we're looking at the various scenarios and seeing if we can replicate in our model, the Willery-Winn model, what was going on in ABC Credit Union's model. And we get pretty close in general in terms of these, but we sort of see like a increasing variance kind of here, right, as we're going through, and kind of a little bit of a flip-flop there. So there's always a few things here to sort of drill down to. Most of the time it relates to discount rate, but this is sort of the example that you look at. You try to do it, then to the extent that they're different, you start drilling down into the models to determine what specifically is causing that. We have a lot of talented people that are very good at doing that here. So on the non-maturity side for asset liability management, we'll take a look in our validations at the non-maturity assumptions. So the repricing betas, so as the market movements, how much are these administered rates on savings, checking, and money market accounts moving? Effective maturity is based off a calculation and decay rate. Depositors have continuous and unlimited options to increase or decrease balances. These balances may or may not correlate to market conditions. Yeah, like I said, a way to think about beta is if market rates go up or down 100 basis points, how much would the administered rate change? And so to do this, you can look at the past historics, and this is we do this calculation. I think McGuire started the calculation, and it's kind of done throughout the industries. Sometimes it's done via deposit study, but it's calculated with linear regression that compares the change in deposit rate to the change in the benchmark interest rates. And betas are part of the assumptions in ALM. So for the checking or the share drafts, we usually see betas between 0 and 20. So if 100 basis point would move, this would move up to 20 basis points. For regular shares, which are savings accounts, 15 to 30. So based on the market move changement. Money market accounts are much more, they move more, they're higher beta relative to market rate movements. Even though they're administered, they change a lot quicker. So we usually see ALM assumptions of beta in 40 to 65 basis points. But again, it's most important in the validation that one, they have the assumptions, and two, the assumptions are supported by historic math. The next is effective maturity. So again, for ALM validation, is the effective maturity calculation supported from a deposit study. Most institutions have a deposit study performed every other year. Effective maturity indicates when the last cash flow is projected to occur in the modeling. It's derived from a second regression analysis, modeling the spread between the rate index and the deposit rate versus the average balance for the account. And so the best way to think about it is if market rates change a lot and customers don't really change their behavior by pulling money or putting money into various accounts, it will have a long effective maturity. If interest rates change and people are moving their money very, very quickly, it will have a low effective maturity, which would then in turn be used to calculate the liability durations. And then we have decay assumptions. So decay is analogous to repayment rates, and it can be performed under two methods. One is an account number method, or two, an origination date method. no matter what the method, in most cases they will produce roughly the same results. So again, usually betas, decays, and effective maturities are all part of the same deposit study, usually done every other year, and then usually supported in the or used in the ALM analysis as you move forward. Due to the 2023 failures of Silicon Valley Bank, Signature Bank, and First Republic Bank, liquidity stress scenarios are now significant part of asset liability management. We're starting to look at for these in terms of the validations that we do as well, just to make sure clients are doing these. So usually, I put an example here of some liquidity stresses. So there's normal, mild, moderate, severe, and adverse. And these, over a 3-month time frame, these things that aren't good for the financial institutions happen. Their CDs run off, their money markets run off, their savings run off, they have more on unfunded commitments. There's reduction to funding lines, right? And so we run these adverse scenarios over 3 months. Again, we're going to try to stress the institution on liquidity, and then we're going to see what they can do. Can they offer new CDs, new certificates? Can they get new borrowings available from their lines? Can they sell anything available for sales, loan sales, reduction to new lending? So again, here's the scenario, here's the response. Part of this analysis also is including policy ratios, financial ratios on this as well. I didn't have enough room for the slide to show that. But we are definitely verifying that financial institutions are performing these and that that they know what to do in case of faced with this type of adversity. So looking at some ALM validation recommendations, just some that have kind of come up and kind of, as opposed to the actual client, we'll just kind of bring it up under ABC Credit Union. But we recommend ABCCU review and correct the modeling setup for noted inaccuracies in its modeling of adjustable rate loans, which specifically relate to interest rate reset and interest rate floor assumptions. Not uncommon that we'll find some issues with adjustable rate modeling when we do the validation. Well, it's pretty easy to figure it out. It's pretty easy to correct for the clients moving forward. Related to policies, this is one we don't see too often, but came across it. But we recommend that ABCCU develop a detailed concentration risk policy for its loan portfolio. The policy should establish concentration limits based on loan type and credit quality. Implementing such policy helps to mitigate risks associated with overexposure to a single loan type or credit segment while supporting a balanced portfolio. Again, we're checking the policies to the extent that we notice, like, here's an organization that doesn't have a policy that should have one, then we certainly note it in terms of best practices. Here's one that relates to economic value of equity. We recommend that ABCCU adjust the discount rates used in economic value of equity analysis based on loan credit quality. This way, a high credit quality loan would be discounted at a lower rate, resulting in a higher fair value compared to a low credit quality loan that would be discounted at a higher rate, resulting in a lower fair value. We believe the discounting methodology derives a more accurate ALM profile. This was a client, when we looked at theirs, they took kind of a shortcut with respect to loan discount rates on the EVE, where it should probably better match its pricing. And so from that perspective, I think that would be kind of a fair improvement. Here's one for future, as we're looking at net interest income and future repricing under that constant balance sheet assumption. We recommend that ABCCU review its current static reinvestment rate assumptions for all account categories and incorporate market rate movements by incorporating index forward curves into future yield projections. This will result in a more dynamic and realistic projection of future interest income and expenses. For example, the static reinvestment rate assumptions applied to the base scenarios were the same as the current yields, even for money markets accounts, which typically respond to market rate movements. So again, we're always looking for improvements. Again, we're trying to strengthen financial institutions. We'll kick the tires hard and provide some actionable recommendations. No, and then there's one where it's consistency. I think in this particular example, there were some differences between the net interest income and the NEV simulation, which we typically don't see. So we wanted to align the prepayment speeds here, also align the decay assumptions because they were different, and then sort of the rate shocks as well. So you never know what you're going to see in all this stuff, but again, we have trained professionals that can do all this. And did we get all our polling questions, or we got one to go?
One left.
Okay, so we'll do our last polling question here. Go back to the slide to help. Oh, here it is. So if the asset duration is 4 and the liability duration is 2, we're in this scenario here, and we'll perform better as rates fall. Let's see. All right, I think we can close it. Okay, I guess at this point I'd like to extend my gratitude for the opportunity to speak to Baker Tilly this morning. I want to thank both Moss Adams and Baker Tilly for being extremely supportive of Willery Wind through the years. It means so much to us. I appreciate the opportunity to try it out. Any comments or improvement ideas, let us know, but thank you so much.